What is up, YouTube? Matt McKeever here, and I'm joined by Josh and Ehren from the Findlay Mortgage Team. Hey, guys, how's it going?
I'm good, man. How are you?
Doing well. So today we're just going to do some Q&A. We've already got a few questions queued up from the audience. If you guys have any mortgage, financing, real estate-related questions, jump in the comment section, and we'll be more than happy to cover them. But a few of you guys hit us up earlier today on Instagram. So question number one we've got is, when it comes to LTT, which is land transfer tax, anyone at home, what do you pay that in regards to on the price if I'm looking to, say, transfer a property from personal ownership, so my personal name, to a corporation? So I know this isn't necessarily really a financing question, but do you guys want me to cover it, or do you guys want to touch on it?
Sure. I mean, you can cover it. We can cover the mortgage side of things if you want.
Sure. So yeah, when we're looking at land transfer tax, it's going to be on the value of the property. Now, what's the exact value of the property when you transfer it into your corporation? Well, that's probably a discussion you're going to want to have with your real estate professional and likely your accountant, because there are going to be some consequences to that. You are going to end up paying land transfer tax if it transfers between legal entities. So you're going to want to think that through before just doing it. Question number two is, in regards to insured mortgages, can they be refinanced? Someone's thinking of refinancing their duplex, but worried if there would be heavy penalties for doing it within a year. So yeah, let's first maybe explain what an insured mortgage is, and then if you guys can touch upon how that insurance is normally paid through the mortgage proceeds, and then we'll kind of go from there.
Yeah, definitely. So for anyone who doesn't know, an insured mortgage is a mortgage when you put less than 20% down, or if you want to get really into it, you could still technically put 20% down. But insured mortgage has mortgage insurance on it, so that's going to be provided by one of the three insurers in Canada. You got CMHC, there's Genworth, and then there's Canada Guarantee, or Sagan, I guess, is now Genworth, or Genworth is now Sagan. But those are your three insurers in Canada. What happens is the insurers basically insure that mortgage because it is a high ratio, and as a borrower, you don't really have any skin in the game. It gives the lender a little bit of confidence that if anything were to go south on that high leverage, that they are covered. So when you go in with an insured mortgage, you do have an insurance mortgage premium that is added to your mortgage. If you're putting your basic 5% down, it is a 4% premium. So the important part to realize here is that when you have that 4% premium and it's tacked on to your mortgage, because you're only putting 5% down, you effectively only leave yourself 1% equity in the property. So for those who are looking to do a BRRRR type strategy and are, maybe only stuck with 5% down, it makes it much more difficult to be able to go through and actually, complete that BRRRR, because not only do you have to force appreciate your property essentially 20% just to get it to 80% loan to value, but anything else that you want to take out in equity on top of that, you have to further appreciate the property. So, it requires much more substantial amount of work than what a standard BRRRR is going to. Because you have that mortgage insurance premium added to your loan amount, you're going to be paying a higher exit penalty based off of a higher loan amount. On closing as well too, you're also going to have your mortgage insurance premium tax that we can't amortize. So there's another little fee that's going to be in there, which again, if you only have enough funds to put 5% down, then that's kind of your situation. But if you can avoid putting 5% down and go with 20%, the ideal, you're saving some of these little costs that you're essentially just throwing money away if you're going to refinance within a year or two anyway. So
yeah, touching on the penalty side of things, your penalty is going to be dictated by the type of rate you're going to take. So if you're taking a fixed term, that fixed term is going to come with an interest rate differential cost. If you are looking to break your term within the first year, I highly recommend not taking a fixed term. It's going to be very expensive for you. Your variable term comes with something called a 3-month interest penalty. It's exactly as it sounds. It's 3 months of interest that you pay when you restructure your debt or break your mortgage. If you are looking to execute on your BRRRR strategy, we highly recommend taking on a variable term. When it comes to breaking your term, there isn't like an additional cost of doing that when it's a insured mortgage. It's just you're going to essentially absorb the CMHC fee that you had to take on acquisition and the 3-month interest penalty when you break your loan. So And one last thing, it's talking about, can you do it within a year? You can do it within a year. Most lenders, again, we're seeing around between 6 and 12 months. They want to see you in the project. The earlier you're going to break your term, the more proof they're going to want to see that you force appreciated the property. Keep track of your renovations, your receipts, your budget, how you did it, before and after photos. Any more ammo that we can have to be able to show how you actually force appreciate the property is going to create more success for you down the road. So a little bits of information. Hopefully we were able to answer that question.
Yeah, appreciate you guys sharing that, because while it sounds like maybe a simple question on the surface, there's actually a lot to it. So just to reiterate there, guys, let's say, I know people are going to get triggered by how low this price is, but let's say you were buying a $200,000 property and you're going to put that 5% down on the property. Well, it sounds like you're going to put 10,000 down and you'd have, $10,000 in equity. But once that CMHC fee comes into play, it might be $7-8 grand in total. So all of a sudden now we've really just got $1 or $2 grand in equity there. So essentially, the moment we commit to that insured mortgage and we close on the property, we paid the premium. So while there isn't necessarily a fee associated with breaking that CMHC or whatever insured mortgage, it is important to keep in the back of our minds that if we were looking at our total cost of borrowing on an annualized basis, if we knew that we were going to be refinancing the property within a year, it's going to look a lot more expensive to use an insured mortgage than it otherwise would, say, if you were planning to hold the property for 5+ years. So I think it's just really important to know what you're getting into on the front end with your plan for that property. And it's going to be rare that it's going to be enticing to want to, go the CMHC route, I think, because you're going to pay such a stiff penalty up front. And, as Ehren was mentioning there, we're not going to be able to refinance back to a 95% loan to value, right, guys?
Yeah, exactly. Yeah, you got to refinance out at 80% loan to value. So you really got to be able to, it's not impossible, but, we would run the numbers ahead of time and just say, hey, look, if you're going to complete this, if you're buying this property at 500, you got to get 750, to be able to make this work, to be able to pull out, any sort of equity. So we can let you know what that ARV value has to be. And, if you can hit it, perfect. If not, you might have to wait until year 2 to get that money out.
Yeah, I've seen many people attempt it. I've warned them all. Very, very few have ever come out on top of being able to do it in the first year. So,
yeah, appreciate that perspective. And so we've got another refinance question here, but not to do with insured mortgage. So can I refinance a mortgage within less than a year? What would that incur for additional penalties? So that's usually, if I'm on variable, just going to be that 3 month, right?
Yeah, 3 months if you're on variable. Again, if you're on fixed, it is the greater between the interest rate differential and the 3 months interest. Something to kind of keep in mind too, when you're in an IRD penalty, that interest rate differential, it does depend on the market, the interest rate market. It takes a look at your current mortgage rate and what the posted rate at that time of exiting your mortgage is with a lender. So if you're in a situation where we have kind of been in the last few months where the interest rates are actually increasing and you're exiting your mortgage into a new higher rate, most lenders automatically convert into a 3 months interest. So I have had a couple of clients that got into a fix at a pretty decent rate. The fixed rate went up. They wanted to exit out. It actually only cost them 3 months interest to be able to exit out just due to that increasing rate environment. So it does depend on the environment, but in most circumstances, if the new posted rate is lower than your current rate, you're going to be paying that IRD penalty. And depending on where you are in your term, usually the rule of thumb that we use is if you're in the first 50% of your term, you're probably going to be subject to that IRD penalty. And then depending on how high of a mortgage payment you have left or how much mortgage balance you have left, it can be a pretty substantial penalty, again, too, depending on how much interest rates have changed. So if you're getting into an interest rate now where you're locking in at 1.35 and in maybe 2-3 years from now, interest rates go up on the fixed rate and maybe they get back into a 2.5-3% environment and you want to break, you may not be necessarily subject to that IRD. You may be able to just revert back to that 3 months interest. But if it's the other way around, and you got that huge difference, it can be a pretty hefty penalty exiting out of a 5-year fix early.
Yeah, appreciate that. And I see a bunch of people jumping in here with more questions. So keep hitting us up, guys. But we've got one more that was asked on Instagram that we'll cover here first. I got a feeling I may end up being the one answering this, but so let's say I have a second residence on a property, and that person A wants to buy in and be on title, but not on the mortgage. Say the bank appraisal comes in at 500K and there is 315 owing on the mortgage. Person A wants to put in 185 for 37% ownership. Would the bank do this, and can I arrange it so I receive this 185,000 and do not put it on the mortgage? So I think I'll just summarize the question here, and then you guys feel free to share your perspective. But essentially, to the best of my knowledge, there's very few lenders that are going to be fine having multiple people on title, but not having those individuals also on the borrowing or mortgage documents. So to the best of my knowledge, whoever is on title is also going to pretty much always have to be on the mortgage. Is there any situations that you guys can think of where that's not often the case?
Yeah, I mean, you can't be on title and also not on the mortgage. So it's one or the other.
Yeah. And then just one other piece of advice I'd give here to the person that asked the question is that's a very specific percentage, 37%. And that makes me feel like someone's got kind of a hammer and they're looking for a nail. And what I mean by that is sometimes when people have a certain dollar amount or they've already got a property, they decide rather than go find a new property or take on new risk, let's just see if we can smash this together. I suspect that you guys will likely be better off to draw up an original arrangement on a new property and just kind of move forward on that. But that's just my bonus unsolicited advice in that regards. So jumping over to some of the YouTube questions now, we've got one from Matthew here. Hey guys, this is exactly the show that I've been looking for. I recently purchased a secondary home. I only put 5% down, so I required an insure. My wife just got temporarily laid off, and we were discussing putting it up on Airbnb to help cover the mortgage. I know one of the documents that I signed stated that I can't rent this place out. It was a very vague document and said nothing about occupying this place for half a month and renting it out for a weekend or two a month. I was wondering if I could rent it out here and there. Who's going to catch me? What happens if I get caught? Thanks for the help. So I think there's probably a few things that we should break down here because this isn't necessarily black and white, or at least from my perspective, it's maybe not going to be a black and white situation. So one, in your exact situation, Matt, obviously the devil's going to be in the details. So I would pull out that contract or talk to your mortgage broker or the person at the bank you dealt with and get a clear understanding of exactly what it is you signed. But let's talk in general, guys. If someone's looking to buy a secondary residence or maybe even their principal residence, it's going to be an insured mortgage. And, their original intention was to live in the property, but then after they've closed on it, life's changed. Are they allowed to rent it out? Can they partially rent it out? What's kind of traditionally what you guys see?
Sure. So we get this question a lot. When you're purchasing a property, it has everything to do with the intent at the time of purchase. If you bought the property with the intent to live in it, then you signed documents stating it wasn't going to be rented. There are many people who purchase property, live in it for quite some time, and then decide that they would like to go buy another property, and they restructure their debt, go buy another property, and then they rent that one out. It doesn't mean that your mortgage is void. It just means that life has changed, and you decided to go and move to a different primary residence. In regards to the documents you signed about living there as a permanent residence, at renewal, they probably request information in regards to what is going on with the property. Is it a rental? Do you live there? Stuff like that. So it's kind of a gray area for us, and I can't really give advice in regards to what to do in that situation. But it has everything to do with when you purchase the property, you have the intent to live in it as an owner-occupied residence or as a second home, then you would have signed those documents, and life does change. So, there are people who do Airbnb the properties. There are people who rent out their properties once life happens and circumstances change.
Yeah, really appreciate that perspective. And again, obviously, devil in the details to your specific situation there, Matthew. But again, if you're primarily living in the property and every now and then you're going to put it up on Airbnb, again, I believe most lenders are going to view that as ancillary, as in like that wasn't your primary thing that you were buying it for. That wasn't your primary focus at the time. So I suspect that you'll be fine. But again, if you want to err on the side of caution, just chat things through.
Yeah, so one other thing I would just jump in there quick too is that no lender is really on board with Airbnb at the moment. So there's a difference between turning your primary into a rental versus just using that property as an Airbnb. So, I mean, yeah, lenders just aren't on board with Airbnbs right now. So I would probably not tell a lender you're going to use it as an Airbnb.
Mm-hmm.
Yeah.
And then, so next question here. I own a primary residence in the GTA. How can I buy a second property with 5% down payment?
Yeah, that's a good question. So you can do something what's called like a secondary home. So you can buy, like, let's say you wanted to buy a 4-season cottage. You are able to get into a 4-season cottage with a 5% down payment or an insured mortgage. Now, if you're asking how can you come up with a down payment, I mean, there's a few ways that you can come up with that. Obviously the first one is just a standard refinance. If you have enough equity in your property, you can do either a first, like a completely new refinance, or depending on which lender you're with, you might even be able to do a second mortgage with them to be able to pull some equity. You can take that equity, put that towards your purchase, and to secure that property. Now, if you are unable to, let's say you couldn't, I mean, like you could look at private mortgages as well too. If for some reason you weren't able to afford both your refinance and your purchase, I mean, that's a good touching point. So one thing to consider when you're refinancing a property and you're going to buy a new property, if you're putting those proceeds towards the purchase, you're supposed to disclose obviously the purchase on the refinance, and obviously the refinance new numbers are going to have to be used on your purchase to make sure that you can afford both. So if for some reason you weren't able to afford, a brand new first on the refinance and the purchase, you could look at using a private mortgage to close your refinance. Now, I mean, again, that's technically going to have to be disclosed to the lender. But yeah, I mean, using the refinance of your property is usually the best way. But you can go ahead and secure a secondary home with 5% down as an insured to kind of save that answer there.
Yeah, I think I understood maybe that question a little bit differently. So there's 3 insurers in Canada, as Ehren outlined earlier. You can have a owner-occupied property with each insurer. So 1 insured property with each insurer in Canada. So if you own a property right now, you have a CMHC insured property, you lived in there for a little bit and you decide you want to go buy another one, you can go do that with Genworth or CMHC at 5% down, as long as you're living in it. You can also use the rental property on the current property you live in if you're going to be moving into your new subject property. So Ehren answered it. I answered it. Hopefully that added some clarity to yes, you can go buy another home in the GTA with 5% down, as long as it's under $1 million, because it has to be, if it's insured, it's got to be under $1 million. So just keep that in mind.
Mm-hmm. Yeah, appreciate that, guys. Next question here. If you pay cash and plan to refinance later, is there any specific timing a person should be aware of?
Yeah, I think we've hammered this a few times, but 6 months is really that kind of that time period that a lender wants you to be in the property for. I mean, we've done refinances within 6 months. It's not always the most easiest thing to get done. Some lenders have a lot more due diligence. They're going to ask a lot more questions. Where did the cash come from? Like, they may want to see proof of the 90 days of those funds being in your accounts. Depending on how large that purchase was. Most homes aren't, $100,000, couple $100,000 these days. They're going to want to see where that money came from. It's all about anti-money laundering and just making sure the funds weren't illicit funds. So be prepared to show some due diligence on the cash, 90-day history before purchase. If you can pass all of those conditioning, then you might be able to close it early. One thing to be aware of is if you closed on it in cash and you're looking to refinance it out at a much higher value, they may only do the purchase value and not the new appraised value. Anytime you're within that 6 months, that is a possibility. So there could be a couple of conditions. There could be a couple of limits on how much cash they're going to give you and the loan to value. They may just do it off the purchase price, the original purchase price, and not your new appraised value. But it is possible to do within that 6 months. 6 months is really the timeline that everyone should kind of keep in mind and strive for before looking for a refinance.
Awesome. Next question here in relation to vendor take-back mortgages. How can a VTB work on a property with existing mortgage? Is the only option to look for a lender who will allow this? Any suggestions to which lenders, both residential and commercial?
Okay. So in regards to VTBs and mortgages that are currently in place, so for residential real estate, conventional lenders do not allow secondary financing on purchases over 80% loan to value. So in regards to like conventional residential real estate and mortgages, you're not able to get a VTB with a conventional lender. In regards to commercial mortgages, we have some videos on how this works, but essentially if the seller wanted to give you a vendor take back, you would have to figure out exactly what the terms of that vendor take back are. So you outline the amortization, how long the term is, the payment, and then we would factor that monthly debt obligation into your expenses. And as long as that expense was added to your overall expenses and your net operating income was able to produce a high enough debt service coverage ratio to allow the lender to be able to feel comfortable with the monthly payment, then they would allow you to debt service it. Very rarely do we see this unless it's a building that's operating at an extremely high level. On acquisition, it's extremely rare. Most investors aren't purchasing commercial real estate that is operating at that level. So it's hard to be able to factor in that debt servicing payment with a conventional lender. But if you did find a unicorn, it's definitely possible to do it if the numbers work.
Yeah, one thing to keep in mind too is that even on that commercial side, they're not going to allow you to do the full 25% down with the vendor take back. They're still going to want you to have some cash in the game, some skin in the game. So, if it's a really, really, really strong deal and you're a super strong borrower and you have a really good reason, and you might be able to stretch that VTB to 15%. But for the most part, they're probably going to want the majority of the down payment to come from your own fund. So you're probably looking at maybe a 10% vendor take back and then 15% borrower cash. But it can be done. Again, like Josh said, it's got to be a strong deal. You got to be a pretty strong borrower and just have they want to understand what's going on and what the situation is. So.
Yeah, appreciate that, guys. And I know as well, when dealing with the commercial side of things, also credit unions sometimes can be a good option there because they're not quite as beholden the way the main banks are.
Yeah, next specifically question. Because credit unions are provincially regulated and banks are federally regulated.
Yeah. So next question here. I've got an investment property, currently refinancing it. If I plan to buy a second property using the refinancing as a down payment for the second property, does it limit my mortgage qualifications and budget? I know you kind of touched upon this earlier, Ehren, but you just want to re-summarize?
Yeah, I'll do a better job this time. So when you're refinancing your property to pull out equity to put it down on the purchase, the best way to get it done is to do it with the same lender. There's a couple of reasons why. One, depending on how much you're looking to pull out, most lenders are limiting you to around $200,000. Now, if you're pulling out 150, 180, they're still going to ask you, like, what are these funds going towards? You're supposed to disclose that you're buying a new property. So it is very hard to, try to lie to a lender and say, well, I just want, $200,000 for, some pocket change. They're going to have to give them a reason. So we typically do it with the same lender so that we can set up both applications to have the purchase and the refinance numbers and make sure ratios work on both sides. That's really the best way to be able to get it done. It allows us to easily disclose that you're using the funds for that. They don't have as big of an issue when you're pulling out large amount of equity to be able to put that towards the purchase. They know exactly what it's going for. We can work with the lender as well too if they're getting both the purchase and the refinance. Sometimes they might be a little bit more flexible if they're getting both deals, and we can find a way to make it work. Now, if for some reason both don't work on the A side, and maybe you can only refinance your property on the A side, but your new purchase has to be done on the B side. We've had files like that as well too. Again, we would just have to disclose to the purchasing, the purchasing lender who's doing the purchase. Again, the funds are coming from the refinance. We'd have to use the refinance numbers on your new mortgage. So to answer your question more specifically, yes, it could potentially reduce your ability to qualify. Really depends on what your debt ratios are. So if you've had your mortgage for maybe 10 years and you've never refinanced it, and now your property is worth $1.5 million, and you try to do a full 80% refi, that huge increase in mortgage could very well decrease your ability to purchase a new property.
Awesome. Next question here. On one video, I think I heard you mention that commercial mortgage is still possible on 2 to 4 units, small multifamilies. Did I hear that right? Is that the case? Will they still evaluate DSCR?
That is correct. Yep, there is small commercial products for multifamily residential real estate as well. We do have to stress test those rates. So we still stress testing at 5.25%, but you can stress test the actual property itself and how it's operating. So if you do have a 2 to 4 unit, this product works great. Usually in secondary markets, just because of the price point of most primary markets at the moment and the rent that most smaller multifamilies are fetching. But it's a phenomenal product. A lot of our investors use it. There's a handful of different lenders out there that offer it, all with different rates and terms, different locations. We definitely find this extremely appealing to most investors.
Awesome. And a follow-up question here in relation to that. Are there any general rules of thumb as to how much private lenders require of personal funds invested in a deal? Does it differ if you are looking for construction loan versus entire property plus rehab?
Yeah, I mean, every private lender is different. Every lender has their own parameters that they look for. Some are a little bit more lenient. Some, are a little bit more strict in terms of having cash in the game. Some private lenders may allow you to have a 15% VTB and only put 5% in. Some probably still want you to have the majority of your own funds in the game. It really, where's the property located? What is the resaleability of the property? Are you buying the property undervalued? Why is it undervalued? Is it vacant? So, I mean, it all depends on, what the situation is. When you take a look at, from the lender's standpoint, I think we actually did a video with you, Matt, that was like through the eyes of a lender and kind of like what they're looking at on every deal. But essentially a lender looks at a deal and says, like, what happens if this goes south? If I have, 98% loan to value in this property and this guy, can't complete his construction project or his rehab project, and I'm left with this building and, he's gutted it and there's no value in it now or less value, he's not going to be able to get his full loan back when he tries to sell that. It's going to sit on the market. It's going to require someone with special abilities to be able to come in and pick up that project from where it's left off and be able to complete it. And by the time that's all said and done, he's probably lost 10 to 15%. So he's going to lose money on that. So when you're doing a really high loan to value, 95, 98, 100, 110% loan to value, they're going to come in and ask for a piece of collateral type property. The collateral property allows the lender in an event that you do end up walking away from the project or it does go south and he has to sell it and he loses money on the specific subject property, he has access to equity in your additional property to make up for any of the money that he's lost on your file. So, putting 5% down, it's quite possible. He may want a piece of collateral property just to securitize it. Or he may want to see some sort of, additional documentation to, show why he should be able to get this done at that higher loan to value. So every lender is different. Every lender kind of has their own perspective, but typically they're still going to want you to have a decent amount of money in there. Maybe, at least 10% of the down payment come from your own funds to kind of keep that skin in the game.
Mm-hmm. Another question here. If I buy a property for 5% and pay mortgage with insurance and later around a year, I put 15 principal through pocket or like out of pocket, would the insurance be removed from the later mortgage amounts?
Negative. We actually just explained this, but essentially once you acquire an insured mortgage, the entire insurance premium is added on to your loan amount. So that is a cost up front, like a piece of debt that's added on to your mortgage that you have to pay off. So if you sell it, discharge, refinance it, that loan amount is not going away. So, you could put the 15% principal into the property and force appreciate it and try to refinance it. But the insurance, if you do refinance it, well, a lot of people don't know this. So if you have an insured mortgage and you buy an insured product, but you refinance it and it's no longer insured, it's not an insured product anymore. So when people say they buy a property with CMHC and then they refinance it and they want to go buy another property, they can actually go buy a property with CMHC owner occupied because they don't have an insured mortgage with them anymore. So once you refinance a property, it's no longer insured and you don't have that insurance, but you still have to pay for the premium.
Yeah. So essentially, from most people's perspective, there's really not a benefit to wanting to put that 15% down within a year. If you have it on the front end, it can make a lot of sense to avoid paying the CMHC or whatever your insurance is. But outside of that, it's probably not going to make sense. Next question is, are there lenders that will take 100% of rental income instead of 50%? They're having trouble refinancing.
There are a couple B lenders that will take a look at 100% of rental income. It's not a whole lot. The majority of B lenders use 80%, 75 to 80%. Like I said, there are a couple special products out there that do use 100%, but usually 80% is significant enough usage to allow us to be able to get that property financed if they aren't able to get it done on the A side.
Yeah, and Jessica, the lenders you're talking about, they're probably conventional lenders, so they're only adding back 50%. Whereas, there are some conventional lenders out there that have a different approach to using rental income to qualify. So there's some that have a surplus deficit calculator, meaning they'll use a larger amount of the actual income. And then they'll see, then they'll deduct all the expenses that you have on that property. And if it's a surplus, they'll actually use that and wash the property, meaning it doesn't need to be used to qualify on your new mortgage. There's a handful of different types of lenders that utilize rental income in a different way. So if you're having problems with the conventional lenders just using 50%, there are different lenders out there that have better or more aggressive underwriting on the A side.
Awesome. Next question is, I'm in the process of refinancing my primary to purchase a rental with a partner 50-50. Is there any reason we can't put an offer on a property now, assuming my refinancing is done before closing?
I mean, no reason you couldn't.
You just might not want to go firm if you're planning to use the proceeds of that towards.
Yeah, I mean, it just depends on how confident and what the time frame is. I like to be able to give a couple weeks between the closing of a refinance and the purchase. That just gives time if there's for some reason any issues with the closing of the refinance. I mean, every now and again the lender sneaks in a couple extra conditions if something comes up. So give yourself a few days, give the lawyer a day to be able to prepare the statement and get the funds ready. But no, I mean, I've had people want to close the refinance and the purchase on, 1 day apart, and I don't recommend it, but it's all done pretty well. So, no reason why you couldn't. It just depends on how much faith you have in your broker to get it done.
I think there's a saying called "Don't count your chickens before they hatch." If the money isn't in your bank account, it's not your money. So I personally wouldn't be going firm on deals without the money in my bank account.
Yeah, I appreciate that, guys. And last question here we've got. So you guys are based out of Ontario. Do you work with clients outside of province? And specifically, do you work with clients in BC?
Yeah, we can work in pretty much every province. We own a DLC franchise, so we can submit into our access desk, and we have the availability to get things done. I'm doing one in Halifax right now. I know I was doing one in BC not that long ago. We can do residential and we can do commercial financing in each province. And we're not as effective in each other province, especially with the private type financing. We don't have the same connections, but we do have a decent ability to get things done in other provinces for sure.
Awesome. And so there was one last question came in that I think is a good one that maybe we'll actually wrap up on here, guys. But what would be your advice regarding requirements or just any sort of perspective for a borrower looking to want to move from a B lender to an A lender?
That's a good question. I think it's a very broad question. So there's many different reasons why somebody would be using a B lender. It might be debt ratios, it might be credit, it might be income. There's a reason why you're with an alternative lender. To be able to get you to a conventional lender, you need to look at the ratios in which those lenders qualify at. So if your ratios were a little higher than they should be, then you either needed to pay off some debt or get your credit back up. Whatever that specific issue was as to why you're with the B lender, I highly recommend fixing that issue. And then you could probably get into a solution as long as your debt servicing ratios are in line. If you are in a B situation because your ratios are in line or aren't in line because you have too much debt, I recommend just paying off that debt. or just speak to a mortgage broker about your potential options available to you. There's lots of different types of lenders. Again, A lenders that are extremely aggressive with rental portfolios. There's A lenders that are aggressive for people who don't have rentals. There's lots of different types of lenders and different products out there. So if you are in a B situation, it's very unique and very specific to your specific situation, but there are ways, and we primarily like to transition people from a B alternative solution to an A solution once we can figure out the financing situation.
Awesome. Well, again, really appreciate you guys coming on the channel, sharing your wealth of knowledge and experience. For anyone that wants to reach out to you guys, there's links in the video description down below. So really do encourage you guys to reach out to Josh or Ehren, pick your favorite, reach out to one of them and get in contact. But again, it's so important that you've got someone on your power team that actually works with investors, right? Because a lot of random questions will come up throughout your investment career. So you want to make sure you've got someone in your corner like Josh or Ehren. So again, really appreciate it, guys.
Yeah, thanks for having us on, man.
Take care, guys.